Man, I love the shorter intro, but I always wish like it would go on longer. I'm just getting into that song. I'm used to the 60 seconds of music preview, but hey, it's a new year. We're going to do new things, and I'm excited to have you along this journey with me. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a kind of consistently rainy Redmond, Washington. I talked to my assistant earlier today, who's based in Kentucky, buried under about a foot of snow. Which is quite unusual for that area. It seems like a lot of the country is dealing with that sort of thing. Here in Seattle, we're cool as a cucumber, kind of 40s and rainy from November through April. No change to that forecast. It remains, but I'm digging it. Overall, quite a distribution day for the major averages. End of the day, only 2 of the 11 S&P sectors finished in the green. The FANG sectors that were all the juice yesterday at the top of the leaderboard, back to the bottom today. And rotating in a position of weakness. Some of the biggest names like Tesla and Nvidia feeling the pain quite a bit. We're going to look at some of the implications. Again, some of the long-term readings are still fine. It's the short-term deterioration that's so concerning. And I would say, from bearish engulfing patterns, like I'll show you in a moment with Nvidia, bearish divergences, like we mentioned yesterday with Palantir, and another name I'll show you here in our chart review. I'm seeing more and more of those, and those are the types of leading indicators that often come before major market pullbacks, similar to the Hindenburg omen that we highlighted in December. So a lot of charts to regroup on. Let's get to the market recap and see what we can tease out. As a reminder, we are live streaming on LinkedIn, Facebook, YouTube, and X. I appreciate you so much. Those of you that are tuning in live, you do have the ability to ask questions. And whatever platform you're on, I can see the questions that you're popping in that comment section. So have at it as we go through the charts and go through the markets. And at the end, I'll take a question or two. Any of the questions we don't get to, we'll go to the mailbag, and we'll do an all mailbag episode on Friday. As a reminder, Thursday the market is closed in memory of President Jimmy Carter. So we're going to do a special episode because of the lack of market activity to recap. It should be fun as we highlight some key charts to review. All right. S&P 500 down 1.1%, 59.09 is your closing value. The Nasdaq Composite almost double that to the downside, down 1.9% to just below 19,500. So we are firmly below the 20,000 threshold. You can see across the board, major averages in a period of weakness today. Mid caps and small caps outperform the S&P slightly, but still down. The S&P 600 small cap and the 400 mid cap index is both down about 0.6 to 0.7%. Only green on the front page is the VIX, which did move almost 2 VIX points higher. Finished today just below 18. So while below our sort of general back of the envelope threshold of high volatility to low volatility, so remaining in a low volatility environment, still not going in the right direction. And while the MOVE index and the VIX, which are the volatility readings for bonds and for stocks, well, they're still relatively low compared to sort of their overall range. They're certainly trending higher through the last 4 to 6 weeks. So certainly something to watch. We're going to dig into the S&P 500 again. That line in the sand at 58.50, no change. I remain thinking that is the level to watch. And as long as we remain above that, it's a lot of noise. But days like this don't feel noisy. They feel negative. So what causes stocks to go down today? We have some economic data before the open today, the ISM reading. A lot of speculation about the Fed. We have our first meeting of 2025 coming up at the end of this month. The market pricing in no change to the Fed funds target rate, which would be, at the very least, a pause in the rate cut environment. The longer end of the curve, the 10-year, 30-year points continue to trend higher. The 30-year point is very close to 5%. The 10-year point is just around 4.7%. And again, the 10-year getting up to 5%, that would retest the previous highs for the cycle, which were reached in mid last year. And so, long-term, long end of the curve continue to go higher. I have a chart a little later just looking at the 10-year yield, particularly Homebuilders. There's that traditional relationship because the 10-year going up and down kind of makes homes more or less affordable if you're borrowing for a long-term mortgage. And you'll see that inverse relationship very clear on the chart a little bit later. I was asked at the end of the show yesterday about the bond prices, and I think it was about the TLT. And so clearly we have a downtrend in the TLT making a new 3-month low this week. So we have a clear downtrend in bond prices, a clear uptrend in rates, and that is the story. The dollar index moving higher today, about 0.4%. As we talk about the risks to look for, the signs of concern, or I guess warning signs to look for, as we outlined yesterday, we hit 3 of them, and the dollar I think is just one of the most important ones. The dollar's been rallying right in Q4, and now in the beginning of 2025. The question is, will that uptrend in the dollar continue? And again, why is that such a big issue? The stronger the dollar is, remember that our U.S. benchmarks are dominated by a bunch of big, huge, mega cap multinational companies, and that's key. Multinational companies, which means a company like Apple is making a ton of money outside the U.S., and when they go to report earnings, they have to convert all those non-U.S. earnings back to U.S. dollars. And if the dollar is dramatically stronger over time, that means their non-U.S. earnings in Europe, in China, in Latin America, wherever else it is, are probably less valuable when you convert them back to U.S. dollars. And so that's why a stronger dollar has often had an inverse relationship with mega cap-led indexes like the S&P 500, and that's kind of what we're seeing here recently. Looking at the commodity space, gold and silver moving higher. Maybe gold a bit of a safe haven here. Anytime you have a day where it feels like everything's going down, always important to notice what's working in the equity space. That's why we'll look at the market carpet, the heat map here in a moment. But also anything else in the green. So crude oil, copper, gold, silver, all in the green today. Cryptocurrencies, boy, quite a bit of red here. The question we asked yesterday, or we posed, was, Bitcoin pushing back above 100,000. That's after kind of languishing through the holiday season. The question is, will they be able to hold that 100,000 threshold? That didn't take long. That was less than a day. Here we're looking earlier in the equity trading session, Bitcoin already down quite significantly. Bitcoin currently just below 97,000. That's down about 5.5%. Ethereum even worse, down about 8% from yesterday. That's just below 3,400. And all 10 of the top coins tracked here on the stock charts platform, all in the red today. And again, what does that mean? I tend to think of cryptocurrencies as a proxy for speculation, right? There's not a lot of fundamental data. You could argue, the limited supply of Bitcoin, I get it. You get the, fundamentals of how much it costs to mine a Bitcoin, I get it. But at the end of the day, the day-to-day fluctuations, I would argue, are based on nothing about that. It's based on speculation and expectations about what the value should be based on its utility down the road at some point. So a lot of red means a lot of risk-off movement in equities, but certainly in cryptocurrencies as well. As I mentioned in the introduction, only 2 of the 11 S&P sectors finishing in the green today: energy and healthcare. 2 interesting ones, right? Because if you think, 2 sectors that were kind of a snooze fest in 2024, I'd probably immediately offer up energy and healthcare. And other sectors kind of had leadership roles at different periods, but energy's been struggling because crude oil prices have remained so low and really have not, sort of moved to the upside. You're starting to see a bit of a rally here in the beginning of the year from crude oil. Whether that's sustainable and whether that drives charts like Devon, DVN, and other integrateds and other E&P stocks higher is an open question. But for today, energy leading the way. Healthcare as well. Some of the best charts we're going to highlight today, and maybe grabbed 1 or 2 of them, I'm thinking, for the chart review in the healthcare sector. Still up about 0.5%, but outperforming the market. The big dogs, the big 3 FANG sectors at the bottom of the leaderboard today. Technology down 2%, consumer discretionary about that as well. Communication services down 1.1%. Some of those big names in tech like Nvidia down quite a bit. Big names in the XLY like Tesla down quite a bit. And these cap-weighted sector ETFs are feeling the pain because of that as well. In terms of breadth, I just wanted to highlight very quickly that, sort of a 2-to-1 ratio of stocks down versus up today for the Nasdaq Composite and the New York Composite Index and most of the major indexes that we're tracking here. So, again, breadth conditions have been deteriorating really since mid-December. Early mid-December, you started to see a rotation lower in some of the breadth indicators that we track. That caused the Hindenburg-Omen to be confirmed. As part of that, the McClellan oscillator breaking below 0, the advanced decline lines rotating lower. We'll highlight a chart in a moment about the stocks above key moving averages. Still over half of S&P members above their 200-day moving average, but we're getting closer and closer to that crucial 50% threshold. Let's look at the Magnificent Seven growth leadership names. Netflix, the best performer, still down about 1/3%. Alphabet and Apple both down about 0.5 to 1%. On the downside, as I mentioned, some of the big losses from Nvidia down over 6%, Tesla down over 4%, and even Amazon down 2.4% as well. So remember, the consumer discretionary ETF, the XLY, almost half of that are three stocks: Tesla, Amazon, Home Depot. Home Depot not doing particularly well either, and so that's what's causing the XLY to certainly struggle quite a bit here. All right, let's look at the market carpet. This is a heat map style visualization. I love things like this that allow you to go broad and very specific, sort of broad and deep, all in the same visualization. I think there's a lot of value. What we're going to do is, as usual, number one, look at the overall takeaways. Number two, focus on the biggest names. And number three, particularly on a day like this, where it felt like so many things were down, let's focus on areas of the market that actually showed strength today. There might be an opportunity in there. So number one, I'm struck, of course, by the red and sort of the overall neutral to negative color that you're seeing in a lot of technology, discretionary, communication services. Those are the three sectors at the bottom of the leaderboard today. And certainly you're seeing a lot of red there. You're seeing, sort of more of a positive vibe from healthcare, from energy, maybe even industrials and materials, which are sectors that have been lagging from the get-go here recently, right? The end of last year, sort of all about the FANG stocks, really fourth quarter, all about the resilience of the FANG stocks, the, resumption of an uptrend driven by those mega cap growth names. Today, very much a counterpoint to that theme, where you're seeing some of those larger names and some of those growth sectors down quite a bit. So growth underperforming value is a key theme that I'm seeing here on the heat map. In terms of the largest names, as we've covered, some of the biggest names down quite a bit. What's funny about the chart of Nvidia, while a bearish engulfing pattern is bearish as obvious from the title, I mean, it's a short-term distribution pattern, and we're still coming off of an all-time high. So it's not like these are charts that are that are incredibly negative yet. They're just really feeling some significant down moves off of very elevated levels, right? Tesla downgraded today by a broker talking about valuations. I think that's an easy case to be made for some of these stocks that have run so much. It's hard to not say that some of these are overvalued based on some traditional metric. But my experience in the financial industry has been, charts being claimed to be overvalued while they continue to go higher for months and months, if not years at a time. So, if something's overvalued, I've found is not ever a really good reason to sell. The trend rotating lower, often a very good reason to sell. And I think that's what you want to focus on here, not, the fact that stocks have run so much, so I probably want to raise cash. It's these charts no longer deserve my capital because the trend is no longer going up. Those are the signals I personally would be looking for. All right, third piece we look at here is looking at some of the outliers. So on a day like this, what was actually up? What are the brighter greens on here? I'm immediately drawn to something like Micron. While a lot of the semiconductors were more flat for the day, Micron actually had a pretty decent update. Solar stocks and other renewable energy like Solar Edge, Enphase, First Solar, all in that same group. Those are four names within the technology sector, showing a bit of strength. Obviously, within energy, quite a bit. DVN is Devon Energy. But again, look at the little chart there. You can see that this thing's been going down for about almost a year, and now it has a nice rally into the beginning of the year. But what's interesting is this is how bottoms often will happen, right? A trend is in place, and all of a sudden it starts to change. So it's sort of like new energy and old energy, all kind of opportunistic here so far this week. Of course, within healthcare and within industrials, you're seeing a number of stocks that pop out. I'm immediately drawn to Delta and United Airlines, some of the airline companies, Alaska maybe in that group as well. But Delta reporting earnings on Friday, I believe. When I bring up the chart, it'll be on there, I think. I'm pretty sure that's a Friday release. Not a lot of earnings just yet. We're sort of queuing up for earnings season to light up in about a week. But between now and then, sort of some straggler random names that report a little bit early in the season. And that could be some of our first information about how Q4 earnings are going to go. But airlines, overall have been quite strong, kind of chopped around going into the beginning of the year. Maybe this is the beginning of a resumption of the uptrend and outperformance. Finally, within healthcare, HCA popping higher, Universal Healthcare, UHS. Again, both of those stocks had been deteriorating through much of the fourth quarter. Going into the holiday season, started to find some stability. Now starting to rally a little bit. Moderna, one of the pharmaceutical names. Again, these are a lot of the names, if you think about a lot of the names that are looking so good today, are names that have been absolute dogs for quite some time. MRNA down quite a bit from 160, 170 about 6 months ago, down in the 40s, but starting to break above short-term resistance. That's how a new uptrend will often start, is a break above resistance and rotation into a Dow theory uptrend. All right, let us continue on and go to the charts. Charts, of course, are central to what we talk about and what we think about. I feel like so much financial media and financial debate out there is based on what should happen, what could happen. When you're talking about the fundamentals, when you're talking about quarterly reports, you're talking about expectations about companies' ability to grow. It is all speculation. It really is, right? You're talking about the company's ability to grow earnings down the road, and you're basically guessing based on what you know and what you expect is going to happen. The type of technical analysis that we promote in Chart This and in my work is called trend following, which is basically not guessing what's going to happen, but analyzing what is happening. And I find so many investors get into trouble because they ignore clear signs that stocks that they own are no longer good stocks to own because the chart's going down. They avoid things, and then all of a sudden this chart really starts to improve, but they wait because they're waiting for the fundamentals to improve. They're waiting for some other story to improve. The charts will tell you when it's a good time to own something and when it's not a good time to own something, I would argue. All right, looking at the daily chart of the S&P 500, again, every time I look at this chart, which is many times a day because I tend to have it rotating on one of the screens over here on my left, it certainly looks like a toppy pattern. This looks like a head and shoulders topping pattern. It's not sort of the classic textbook version of that because we have sort of this secondary right shoulder. We've got multiple right shoulders here all of a sudden. So I don't know if I'm going to end up calling this a classic head and shoulders top, but I would definitely say 5850 more and more seems like a really important level. We started talking about that back here. And during an uptrend phase off of the August low, we will usually use the recent swing lows as our sort of trailing stop, right? That's sort of our line in the sand, right? Because as long as we keep making higher highs and higher lows, we're in an uptrend, right? That's what Charles Dow taught us 100 some odd years ago. But when that previous swing low doesn't hold, when we stop making higher lows, that suggests we may no longer be going up according to that classic definition. So 5850 is really a level that came in mid-November. We gapped above that point. We pulled back there and then made the new all-time high to 6,100 in early December. Now we're seeing, again, continued retests of that 5850 level. I've mentioned a number of times here over the last 6 weeks, as long as we hold 5850, I think anything above there is kind of noise, and I stand by that. Boy, as early as tomorrow, we could break below 5850, and if so, one of the main topics of the episode will most likely be downside projections for the S&P because the line in the sand is not holding. So 5850 is the level. RSI, does that hold 40? That's another one of those interesting tells to make to determine whether something is starting to break down in a more painful way. I want to talk briefly about the Nasdaq 100, ticker QQQ. I'm showing a weekly chart here to start out with. Is that true? I meant to show a daily chart. Okay, hold on. We recalibrate immediately. All right, I'm meant to show this chart first. I think I fumbled the old chart setup there. All right, here's what I wanted to show next. Daily chart of the Nasdaq 100. What I want to start with the daily chart first is to just talk about how the general trend in the Nasdaq has been positive. As much as we talk about the Magnificent Seven stocks being overvalued, as long as we talk about the danger of charts like Nvidia rotating lower, let's just again reflect on the fact that the markets overall on the medium term and long term timeframes, I would say, undeniably still quite positive. And we can tell that by the fact that the Qs are still above two upward sloping, moving averages. The momentum overall is firmly in the bullish range. We have pulled back here over the last couple of weeks, maybe making a bull flag pattern. That's what I wanted to highlight just briefly on this chart. A bull flag pattern is when you have a run higher and then you have this kind of move. It's not a perfect one, I would say, but it's not bad. Hold on, this color's horrible. There we go. And then what we can do is make kind of a parallel channel. This is kind of what I'm talking about, right? You sort of have this rally and then this parallel pullback, lower highs and higher and lower lows. the way that this pattern is resolved in a bullish way would be breaking out of the pattern to the upside. And if so, that would suggest much further upside. So maybe a bull flag pattern in the works for the Qs on the daily chart. TBD, to be determined. But the weekly chart is what I want to look at, because as we debate whether or not this is the beginning of a more painful pullback, which, to be clear, I think it most likely is going to end up being. I think Q1 is going to be kind of painful, given all the signs of warnings that we've talked about into the end of last year. What often can help is to take a step back. What they say is, when in doubt, zoom out, right? When you're wondering what a short-term move means relative to the long-term, go out, step back from your monitor, look at a longer time period, and really just think about the forest for the trees. A lot of times we get caught in, just analyzing the particular veins on a particular leaf instead of taking a step back and really thinking about the forest. And in an attempt to do so, I just want to highlight that the weekly chart of the Nasdaq 100 has given 3 sell signals using the weekly PPO indicator, very similar to the weekly MACD. It's a classic trend following indicator. We're doing it here on a weekly time frame to sort of get away from the noisy day-to-day movements and just look for the longer reversals. The last 3 times that we've had a sell signal, in the July pullback, in the March 24 pullback, in the July-August 23 pullback, those are the last 3 times we had a confirmed sell signal. We arguably are getting that, as early as today. Now, this is a weekly chart, which means it can still fluctuate between now and Friday, but I would say check this chart on Friday to see if the close confirms a PPO sell signal. And if so, that would be the 4th sell signal we've had from this indicator since the 2022 low. The previous 3 times have led to at least a month of painful pullback. So the weekly chart for now, okay, but very close to not being okay, and signaling that this may be the beginning of something further. Now, some of the warning signs we talked about at the end of last year, excuse me, market breadth indicators, right, which tell you that there's less and less participation, less and less stocks participating in the bullish phase. And even though the S&P and the Nasdaq have remained strong into early December for sure, a lot of breadth indicators started to give warning signs as early as October. We highlighted this bearish divergence with the stocks above their 50-day moving average. Now, again, quite a bit of a further upside into early December, but from there, we've seen both of these breadth indicators, the stocks above their 50-day and then the stocks above their 200-day, which is here in blue, both coming down quite a bit from where they were in early October, and certainly where they were about a month ago. So what we've seen are a lot of individual stocks have been breaking down. Most stocks, 3 out of every 4 S&P names, are currently below their 50-day moving average, but still about 54% remain above their 200-day. But this shows you how many stocks have been breaking down through their 200-day moving average just since the end of September. So while the S&P is still firmly above its own 200-day moving average, a lot of stocks have already been breaking down. What happens a lot of times at a major market top is the indexes still go higher because some of the biggest names are still okay, but a lot of other names are starting to rotate lower. I think that's the danger for this market here as we progress into the month of January. I'm watching this in particular to see if this breaks below 50%, because it doesn't happen too often, particularly in a bullish market phase. But when it does, I have learned to get very cautious very quickly. So for now, very close to that 50% threshold. We highlighted the chart of interest rates yesterday. We did this version of this chart, the 10-year Treasury yield, which on stock charts is $TNX. That's an index that comes from the SIBO. And overall, this is meant to show the increase in the 10-year yield from 3.6% in mid-September to now just almost 4.7% in early January. Now, what we didn't show you, we mentioned how home builders tend to move inversely, and that's because, generally, right, if you're borrowing to buy a home, the 10-year going up a full percentage point is not making your mortgage any less expensive. To be honest with you, it's probably making buying a home inaccessible to at least some group of potential homeowners, and could slow down the housing market. That's why home builders start to underperform. So here we're showing the relative performance of the ITB, which is a home builder ETF, versus the S&P 500. We can see as rates have gone higher, the relative performance of this group has gone down. A lot of those individual names have pulled back quite a bit, like Lennar, DR Horton, and others. ITB and XHB are the 2 home builder ETFs we like to track in particular. Cryptocurrencies getting very much a risk-off flavor here to start the new year, although Ethereum prices did rally in the beginning of January, today rotating back lower. And as the equity markets sold off after that economic data came out before the open today, we're seeing Bitcoin and Ethereum and most of the other top coins rotating lower as well. Ether prices, looking at the last year or so, you can see that 4,000 has ended up being a significant important threshold that we've been unable to get above. Bitcoin, it's 100,000. Ether, it's 4,000. That is, the resistance that just continues to hold. I think this chart above 4,000 becomes incredibly encouraging because that means we are finally exiting this broad consolidation that we've been in for quite some time. In the short term, though, I'm concerned by what I'm seeing today. Because if you look at the November rally, I'm taking the low around 2350. That was the low the first week in November. We're taking that up to the high around 4100 that we reached in early December. 38.2% of the way down is 3430. That's what we just broke down below today. If we would continue that lower and go to the next major Fibonacci level, that's around 3020. And that's very close to a big round number of 3,000. That's also very close to a big important moving average, the 200 days. So we have what's called a confluence of support around 3,000. Now, if Ether prices would get all the way down to 3,000, that would represent a 25% pullback from the previous highs from about a month ago. So certainly a downside rotation. These are volatile assets with a lot of movements. And while the long term could be encouraging with a break above 4,000, what I'm seeing today tells me more risk off for now until proven otherwise. All right, I mentioned the bearish engulfing pattern. If you're not familiar with what that is or what that means, here you go. This is a 2-candle pattern, a 2-bar or 2-day pattern where we have an up day followed by a down day. The up day followed by the down day, and the second day, the down day, has a higher open and a lower close. So the real body of day 2 engulfs the range of real body of day 1. With bar charts, that's called a bearish outside day, and whatever type of chart you look at, it's not bullish. And what's concerning about a short-term candle pattern like this is when it happens relative to a key resistance level, that's quite a bit of a concern, right? So the resistance in November was right around 150, and then we pulled back to around 127. We pulled back all the way up to push to a new all-time high of just above 150 today, 152 today, that is. But by the close, we're all the way down to 140. We're now back to the 50-day moving average. And that bearish engulfing pattern suggests short-term weakness. I'm immediately looking at the previous swing lows around 134 as a potential downside target as this week progresses. But overall, that is suggesting the inability of a chart like Nvidia to break out. And if you remember what we've talked about many times recently, the bull case for the S&P and the Nasdaq means names like Nvidia have to break out, right? Meta has to push higher. Alphabet has to push higher. These are the leading names with big weights in the indexes. That's not what we're seeing today. We're seeing more of a risk-off move, suggesting limited upside until proven otherwise. Nvidia is down over 6%. Tesla also down about 4% today. Now, Tesla has been trending lower over the last couple of weeks. We mentioned that potential bull flag pattern in the QQQ. You can say a similar thing about the chart of Tesla, the rally, and then the short-term pullback of lower highs and lower lows, which means if you draw a trend line connecting these highs, and if we would break that trend line, that would actually be a pretty bullish outcome for the chart. But for now, I'm watching that 355 to 360 level. That would be a 38.2% retracement of the way back to the April low, and also is where the 50-day moving average resides. So for now, Tesla in pullback mode, consumer discretionary as a sector struggling as those 3 biggest weights all feeling some pain here this week. There are charts that are actually going up, as we highlighted on our heat map. That's what's beautiful about that sort of visualization, just focusing on what's different, what's an outlier. Moderna came up on the screen today as the top performing member of the S&P, or certainly toward the top of the list. Ended up closing almost 12% higher, clearing the 50-day moving average for the first time since June of last year. So it's been a long wait. Now, here's the problem, right? When a chart like Moderna is breaking out, that's encouraging, right? Getting back above the 50-day, that's good. Getting to a higher high, that's good. Getting, after making a higher low, that's all good. But we've been in such a downtrend for quite some time, which means there's going to be a lot of doubters, not expecting this to really materialize. The other problem is because it's been such a significant drop in value, we have to go quite a bit up to even get to the first Fibonacci retracement level. The 38.2% retracement and the 50-day moving average are up in the mid to high 80s, which would be almost a double from current levels. Actually, it would be over a double. So it'd be 100% gain beyond what we've seen so far just to get to the 50-day moving average. That's how bad some of these charts have been. Having said that, a stock that has been down for so long, a stock rotating higher, buy signals from some of the indicators trend following indicators, momentum improving with the RSI pushing above 60. I have no problem with thinking of that as a potential entry point and thinking about upside targets using good money management techniques to minimize losses if we see a downside rotation. So worth noting, some of those beaten down healthcare names like Moderna starting to look pretty good. On the other side, you have names like Palantir, PLTR, which we mentioned, having a bearish engulfing pattern down again today. BlackRock, also a bearish engulfing pattern. This is why one of the items on my bull market top checklist. I have 7 things on there. One of them is a proliferation of bearish momentum divergences, meaning a bunch of things go up on weaker momentum. And I think we've seen that here November into December. Charts like Palantir, leading names, outperformers, getting a bearish momentum divergence. BlackRock, obviously not in everyone's favorite sector, financials, but has outperformed for about a 6-month run pretty handily and above 2 upward sloping moving averages into mid-December, higher highs in price, lower peaks in momentum. Now we're rotating lower, following through below 1,000, RSI below 40. I think this is a chart that's now broken. I'd be using Fibonacci retracements and other projection tools, retracement tools to identify a potential downside move, but concerning development today there for BlackRock. Final chart here for today would be airlines. I have United Airlines and Delta. Delta is actually reporting after the close, or actually before the open on Friday, I believe. It's Thursday or Friday of this week. But I just want to highlight the chart of UAL is actually a pretty decent chart. Had a really good run August, September, October, November. December, we stall out, but we ended up being more sideways, right? It wasn't a pullback like we saw in some other charts. It's more sideways, a high around 105. You can see the lows holding steady here around 90. Couple days ago, that was Friday of last week, we had a hammer candle as we test the 50-day moving average. So it makes sense that we're seeing a bit of a bounce there. Does anyone know what this candle is? Here on the bottom, this is the Delta Airlines chart. And if you know your candle charts, you'll know it. And if not, shame on you. Dig through the candle list. This is actually called a dragonfly doji. Probably doesn't matter a whole lot, but it's kind of like a hammer candle, but the open and close are almost identical. So it kind of looks like a doji candle with limited upper shadow and a big long lower shadow. They're both sort of reversal candles suggesting an upside bounce. So going into earnings, while the markets as a whole are starting to give a bit of a risk-off feel today, some of these airlines are actually bouncing higher going into earnings. That's it for our chart review. Let me look at the questions as a reminder. I appreciate you guys so much joining everywhere you were at, and I appreciate the questions that you're putting in there. Question number 1, Bull Bear Jeff watching on YouTube. Thanks for a number of questions you put in here and comments as well. Do I use the TSLA indicator? Very helpful for marking possible tops. So the short answer is I don't use it often. The longer answer is I'm very familiar with it, and I have used it before. There are a series of indicators that I would think of, I would kind of generally consider, trend following indicator, maybe trailing stop indicators, I would say. And something like the, let me just make a simple chart here to, where am I going? Okay. We'll do a basic chart like this, kind of simple. And we'll add the overlay, and it's called the parabolic SAR. This is actually called, excuse me, parabolic systems, parabolic studies. Parabolic SAR has a couple different names. This is an indicator designed by Wells Wilder. It was unveiled to the public in the same book that included RSI, DMI on the ADX line, and parabolic systems. It's a book called New Concepts in Technical Trading Systems. It's a really cool book, by the way, because it has Wells Wilder's like accounting ledgers, where actually his hand, calculating all of these indicators. That's a great way to learn the construction of the indicators, to actually calculate them out. So he shows you exactly what he did to calculate it. And this was his version of a trailing stop. And what the parabolic SAR system does is when the market's in an uptrend, basically starts the stop at the previous swing low, and then has a calculation called an acceleration factor, which increases or decreases its pace based on how quickly the market or the chart is making new highs. So I'm a fan of this, and I would say something like this is good if you have a long position and you just want to make sure you don't miss out and don't lose all of it if we rotate lower. Pop the SAR indicator on the chart. The other one that I use, this is kind of similar to this, but I find a little more helpful, is called the chandelier exit system, which is an indicator kind of similar, trailing stop based on average true range. That was popularized by Dr. Alexander Elder, and that's another one that I would point you to as well. Folks, that's it for the show today. I want to thank you guys so much for joining me here every weekday after the close for our show. A special want to thank those of you that are joining live and asking all these great questions. Those questions that we did not get to, we will put them into the mailbag. We're planning an all mailbag episode on Friday of this week, and I hope to answer one of your questions live on the air. Again, markets are closed on Thursday, so we're going to do a special episode of the show. So we will be broadcasting at 5 p.m. Eastern. So I hope to see you there. We'll be on tomorrow as well. So for now, have a great night. And remember, it's always a good time to own good charts. Take care, folks.